The largest silver short positions in banking history just vanished. Not reduced, not adjusted, vanished. $14 billion in margin calls forced institutional hands that had controlled this market for 4 decades. But here's what they are not telling you. The algorithm that kept silver suppressed below $28 was not just broken by market forces, it was deliberately shut down. And when you understand why major banking families are now quietly accumulating the very metal they spent generations shorting, you'll realize we're not watching a market correction. We're watching the controlled demolition of the monetary system you thought you understood. The exit has already begun. Something shifted in the last weeks of the year, but you wouldn't have noticed it in the headlines. While everyone tracked inflation data and interest rate speculation, the largest financial institutions in the world were quietly unwinding positions they'd held for decades. Silver shorts that had defined institutional strategy since the early 1980s simply disappeared. Not gradually, not strategically, disappeared. The kind of silence that follows isn't market noise. It's the absence of control that once seemed permanent. When JP Morgan, Deutsche Bank, and HSBC simultaneously abandoned short positions worth $14 billion in margin requirements, they're not responding to market pressure. They're responding to something far more systematic. Here's what the financial press won't tell you. These weren't isolated decisions made by individual trading desks. The coordination was too precise, the timing too synchronized, the exit too clean. This was orchestrated. But orchestrated by whom? And why now? The algorithm that had kept silver artificially suppressed below $28 for nearly 4 years stopped functioning on a Tuesday morning in November. Not because of technical failure, not because of market volatility. It was deliberately deactivated. The question isn't who turned it off. The question is why institutions that spent 40 years building the perfect control mechanism would voluntarily surrender their advantage. Unless, of course, they know something about what's coming that makes controlling silver prices irrelevant or dangerous. When you control a market for 4 decades, you don't simply walk away. You position yourself on the other side before the system you built collapses, and that positioning has already begun. But before we reveal what they're moving toward, you need to understand exactly what they're moving away from. Because the silver manipulation wasn't just about silver, it was about maintaining an illusion that's about to shatter. 1983, the year silver manipulation became science. While the world focused on Paul Volcker crushing inflation through interest rate shock therapy, a quieter system was being perfected in precious metals markets. The Hunt brothers had shown what happened when silver prices broke free from institutional control. Chaos that reached the Federal Reserve itself. The lesson was learned. Never again. The mechanism they built wasn't complex. It was elegant. Every time physical silver demand increased, paper silver supply would flood the market through derivative contracts. For every ounce of real silver purchased, 50 to 70 ounces of paper silver could be created and sold. The ratio didn't matter. The mathematical impossibility didn't matter. What mattered was control. JP Morgan perfected this system after acquiring Bear Stearns in 2008. They inherited the largest silver short position in modern history and, instead of unwinding it, expanded it. By 2012, their short position represented more silver than global mine production for an entire year. But here's what most people never understood. This wasn't about making money on silver trades. This was about protecting the dollar system itself. Every ounce of silver that held its real value was an ounce that questioned why paper dollars should hold any value at all. When silver was priced at $15 per ounce in 2020, while global silver demand exceeded supply by over 100 million ounces annually, the message was clear. Physical reality is subordinate to financial manipulation. The system worked perfectly for 40 years. Central banks could print unlimited currency, governments could expand debt beyond historical precedent, and precious metals would remain artificially suppressed, providing no alternative store of value for those who noticed the mathematical impossibility of perpetual monetary expansion, until it didn't work anymore. The first crack appeared in March 2020. While financial markets collapsed and the Federal Reserve printed $4 trillion in 6 months, silver prices should have exploded. Instead, they were suppressed even more aggressively. Paper silver contracts flooded the market every time the price approached $30. But something else was happening in the physical market, something the algorithms couldn't control. The algorithm was beautiful in its simplicity. Every morning at exactly 8:30 Eastern Time, it would scan global silver futures positions, calculate the maximum pain threshold for long positions, and deploy paper contracts to push the price just below that threshold. Perfect mathematical precision designed to crush buying momentum before it could build. For 38 months, it never failed. Not once. Silver would approach $28, the algorithm would activate, and within minutes, the price would retreat to $26. Retail investors would panic, sell. Industrial demand would remain steady. The system would reset for the next day. 40 years of perfect control maintained through code. But algorithms, no matter how sophisticated, can only control what they can see. They can manipulate futures prices, options flows, and derivative positions. They cannot control what happens when the physical metal simply isn't there anymore. The first warning sign came from India in September. Silver imports suddenly increased by 300% over previous year levels. Not jewelry demand, not industrial use. Strategic accumulation by wealthy families who understood something Western institutions were still pretending didn't exist. The physical market was separating from the paper market. The second warning came from manufacturing. Solar panel production, electric vehicle components, medical equipment, industries that require real silver, not paper promises, began reporting supply shortages despite official market data showing abundant inventory. The price said there was plenty of silver. The warehouses said something different. The third warning came from the algorithm itself. In early November, it began requiring increasingly aggressive intervention to maintain the $28 ceiling. What had once taken 50 million ounces of paper silver to control now required 200 million ounces. The mathematical leverage was approaching dangerous territory. But the algorithm couldn't adapt to what happened next. Because what happened next wasn't market-driven, it was policy-driven. On Tuesday, November 14th, at exactly 11:42 in the morning Eastern Time, the algorithm stopped. Not malfunction, not overwhelm, manual shutdown. Someone with the authority to override 40 years of market control decided that maintaining the silver suppression was no longer in their interest. The question is, what changed their mind? And why was the shutdown coordinated with the largest institutional silver short exodus in financial history? When you understand the answer, you'll realize this isn't about silver prices. This is about positioning before a monetary system change that's already been decided. $14 billion. That's not a trading loss. That's not a market adjustment. That's the cost of maintaining a lie that became too expensive to sustain. When silver prices spiked above $31 in the second week of November, something unprecedented happened. The largest institutional short positions in precious metals history triggered margin calls that exceeded the quarterly profits of major investment banks. Not individual positions. Coordinated systematic positions held by the same institutions that had controlled silver pricing for 4 decades. But here's what the margin call really represented: the cost of preventing silver from reaching its mathematical equilibrium with currency debasement. Every dollar printed since 2020 should have pushed silver to between $60 and $80 per ounce based on historical monetary relationships. Instead, through massive short positioning, it was held artificially at $26. The gap between reality and manipulation had become a $14 billion problem. JP Morgan alone faced margin requirements of $4.7 billion on their legacy short positions. Deutsche Bank, $2.9 billion. HSBC, $3.2 billion. Credit Suisse, before its collapse, had already warned of similar exposure levels. These weren't sustainable trading positions. They were monetary policy enforcement tools that had become too expensive to operate. But the timing of their simultaneous exit wasn't coincidence. It was coordination. Someone with authority over multiple major financial institutions decided that maintaining silver suppression was no longer worth the cost. Or more precisely, that the benefits of controlling silver prices had been superseded by the benefits of what comes next. When you abandon a 40-year control mechanism, you don't do it randomly. You do it because you're preparing for a system where that control becomes irrelevant, or because maintaining that control would interfere with a larger strategic objective. The institutions that spent decades keeping silver artificially low are now quietly positioning for silver to reach levels that would have been impossible under their previous manipulation strategy. The same banks that shorted silver below $20 are now structuring products that assume silver above $70. They're not changing their minds. They're changing their timeline. And that timeline is much shorter than most people realize, because the physical reality they spent 40 years hiding is about to become impossible to ignore. The warehouses are telling a story that the paper markets can't suppress anymore. The official numbers say there are 1.1 billion ounces of silver available for delivery through regulated exchanges. The unofficial reality is that most of that silver exists only in digital ledgers, backed by promises that were never intended to be fulfilled simultaneously. But something changed in the last 6 months. Industrial buyers stopped accepting promises. They started demanding physical delivery. Solar manufacturers, electric vehicle producers, medical equipment companies, industries that can't function with paper silver, began requiring immediate warehouse receipts for their purchases. The problem became visible in August when Tesla attempted to secure 2 years' worth of silver supply for their expanded battery production. What should have been a routine industrial purchase triggered the first documented silver shortage at London Metal Exchange. Approved warehouses since the system was established. Not a price shortage, a physical shortage. The silver was simply not there. COMEX reported 57 million ounces of deliverable silver in August. But when major industrial buyers began demanding immediate physical delivery, that number dropped to 12 million ounces in 6 weeks. Not because the silver was purchased, because it never existed in the quantities the ledgers claimed. This is the derivative problem in physical form. For decades, the same ounces of silver were sold multiple times through paper contracts, based on the assumption that most buyers would never actually demand delivery. It worked perfectly until industrial demand created a delivery crisis that exposed the mathematical impossibility of the system. Here's the calculation that triggered institutional panic. Current annual silver demand is 1.2 billion ounces. Current annual silver production is 800 million ounces. The 400 million ounce annual deficit has been filled through recycling and above-ground inventory for over a decade. But the above-ground inventory is no longer above ground. It's been consumed by industrial applications that don't return the silver to the market. Solar panels, medical devices, electronic components. Once the silver enters these products, it's effectively removed from supply for decades. The institutions that manipulated silver prices downward for 40 years created an artificial price signal that encouraged massive industrial consumption of an increasingly scarce resource. They essentially engineered their own supply crisis. And now, with physical inventories approaching critical levels and industrial demand continuing to increase, maintaining artificial price suppression would require physical silver that doesn't exist in the quantities needed. The choice became obvious. Abandon the manipulation strategy before the physical shortage exposed the entire derivative system, or risk a broader collapse when industrial buyers began demanding delivery of silver that was never actually available. But some institutions didn't wait for that choice. They began accumulating physical silver months before the official policy change. While retail investors debated whether to buy silver at $26 per ounce, old money was accumulating it at levels not seen since the late 19th century. Not speculation. Strategic positioning by families and institutions whose wealth strategies operate on generational timelines. The Rothschild family increased their physical precious metals holdings by 700% between January and September of this year, not through their public investment vehicles, through private family trusts that don't report to securities regulators, the kind of accumulation that signals fundamental monetary system preparation, not market timing. The Saudi Arabian Monetary Authority began converting oil revenues to physical silver in March, purchasing over 40 million ounces through Swiss intermediaries, not industrial silver for manufacturing. Investment-grade silver stored in non-Western vault facilities, the same silver that their currency policies had previously helped suppress through dollar recycling agreements. But the most significant signal came from China, not the government. Private Chinese billionaires who built their fortunes in manufacturing and export industries. In August, they began liquidating real estate investments and converting the proceeds to physical precious metals, not gold, silver. They understand something that Western financial institutions are still pretending doesn't exist. The industrial silver shortage is permanent. There is no new supply coming online that can meet current demand, let alone future demand from green energy transition and advanced manufacturing. When industrial dynasties that built their wealth through global supply chain expertise begin hoarding a specific commodity, they're not making investment bets. They're responding to supply chain intelligence that won't be public knowledge until it is too late for others to position accordingly. These families don't trade silver. They accumulate it and store it for decades. Their accumulation patterns indicate they expect silver to become significantly more valuable than current prices suggest, and significantly more difficult to obtain than current availability suggests. But there's something else driving this accumulation pattern, something that connects the industrial shortage, the banking exit from short positions, and the strategic accumulation by generational wealth families. They all point to a monetary system change that makes current silver prices irrelevant. When you own the physical metal before the system changes, you benefit from the revaluation. When you own paper promises after the system changes, you own nothing. The signals are becoming too obvious to ignore, but most people won't recognize them until it's too late to respond, because the next phase has already begun. Signal 1, central bank gold purchases reached levels not seen since the 1970s. But they're not just buying gold. Russia increased silver reserves by 400% since 2022. China accumulated 60 million ounces of silver through state-controlled enterprises in 8 months. Iran converted oil revenues to silver at rates that exceeded their industrial needs by 300%. When central banks abandon traditional reserve assets for precious metals, they're not hedging against market volatility. They're preparing for monetary system failure. And when they choose silver over gold, they're betting on industrial necessity overriding investment preference. Signal 2. The largest silver refineries in the world are operating at maximum capacity, but can't meet delivery deadlines. Swiss refineries that typically process silver within 2 weeks are now quoting 6-month delivery times for new orders, not because of equipment problems, because the raw silver they need for refining isn't available in the quantities their contracts assumed. Perth Mint in Australia stopped accepting new silver orders in October. Royal Canadian Mint limited silver product sales to existing customers only. The U.S. Mint periodically suspended Silver Eagle production throughout the year due to blank shortages. These aren't temporary supply disruptions. These are permanent capacity limitations in a market where demand has permanently exceeded supply. Signal 3. Derivative markets are showing fractures that indicate systematic breakdown. The ratio of paper silver to physical silver reached 150 to 1 in September, meaning 150 ounces of paper silver exists for every ounce of physical silver available for delivery. This ratio was 30 to 1 in 2000. But the real signal isn't the ratio, it's the premium. Physical silver is now trading at premiums of $6 to $12 above spot price. When physical markets separate from paper markets by those margins, it means the paper price no longer represents reality. It means the physical metal has become scarce enough that real buyers will pay significantly more than the manipulated derivative price. These three signals converge on a single conclusion. The silver market has bifurcated into paper promises and physical reality. The paper market is still controlled by algorithmic trading and derivative manipulation. The physical market is controlled by scarcity and industrial necessity. This bifurcation is exactly what preceded the gold market breakdown in 1971. When the paper system becomes disconnected from physical reality, governments face a choice: admit the manipulation or change the system entirely. Nixon chose to change the system. The current situation requires a similar choice, but this time the change won't be abandoning a gold standard. It will be acknowledging that industrial silver has become more critical to economic functionality than paper currency systems. Silver remembers. While currencies can be printed infinitely and debt can be expanded indefinitely, silver maintains mathematical relationships to energy, labor, and industrial production that no monetary policy can override permanently. 1 ounce of silver has purchased approximately the same amount of wheat for the last 300 years. 1 ounce of silver has purchased approximately the same amount of crude oil energy equivalent for the last century. These relationships exist regardless of what currency systems claim silver should be worth. But here's what makes silver different from gold. Silver is consumed. Industrial applications remove silver from the monetary system permanently. Electronics, solar panels, medical equipment, water purification systems. Once silver enters these products, it doesn't return to circulation. Gold can be melted and reused infinitely. Silver disappears into industrial infrastructure. This consumption creates a deflationary spiral that no amount of paper silver manipulation can overcome. Every year, global industrial demand removes more silver from above-ground supply than mining can replace. Eventually, the mathematics of scarcity overrides the politics of price suppression. That point has arrived. The Federal Reserve can print dollars infinitely. The European Central Bank can expand their balance sheet indefinitely. The Bank of Japan can purchase unlimited bonds. But none of them can print silver, and none of them can replace the industrial silver that is being consumed faster than it is being produced. When currencies lose purchasing power through inflation, their relationship to silver reverts to historical mathematical norms. Based on the total dollars created since 2020, silver should be priced between $60 and $80 per ounce to maintain its historical purchasing power relationship to currency supply. But the relationship goes deeper than purchasing power. Silver has become essential to the technological infrastructure that modern economies depend on. Without silver, solar energy systems don't function. Electric vehicle batteries don't operate efficiently. Medical imaging equipment doesn't work. Internet connectivity becomes unreliable. A monetary system that suppresses the price of a metal essential to technological civilization creates systemic economic instability. When silver becomes too cheap, industrial demand increases beyond supply capacity. When industrial demand exceeds supply, the monetary system loses access to a resource it cannot replace. The institutions that spent 40 years suppressing silver prices finally understood this mathematical reality. Maintaining artificial suppression would eventually destroy the technological infrastructure that their own economic system depends on. The choice became simple. Allow silver to reach prices that balance supply and demand, or risk technological infrastructure breakdown that would collapse the broader economy they were trying to protect through currency manipulation. They chose rebalancing. But rebalancing means acknowledging that silver has become more systemically important than maintaining artificial currency stability. The mathematics are simple. The institutions that controlled silver prices through short positioning held contracts representing more silver than exists in above-ground, refined, deliverable form. When industrial buyers began demanding actual delivery, the system faced a choice: deliver silver that didn't exist or abandon the manipulation strategy. They chose abandonment. But abandoning a 40-year control mechanism creates consequences that extend far beyond silver markets. Now, when the same institutions that suppressed silver prices begin positioning for much higher silver prices, they're essentially admitting that their previous strategy was artificial market manipulation that prevented natural price discovery. This admission has implications for every market they've touched. If silver prices were artificially suppressed for 40 years, what about gold? What about other commodities? What about bond markets that benefited from precious metals suppression? What about currency values that depended on precious metals remaining undervalued? The answer is systemic reevaluation. When one pillar of market manipulation collapses, it exposes the artificial nature of related market structures. This is why the silver short exit isn't just about silver. It's about maintaining credibility in financial markets that depend on the appearance of legitimate price discovery. But there's a deeper problem. The institutions that manipulated silver prices downward for 4 decades created massive industrial consumption based on artificially cheap silver prices. Solar energy expansion, electric vehicle production, medical technology advancement. Entire industries scaled their operations, assuming silver would remain cheap and available. Now those same institutions face a supply crisis they created through their own manipulation. Industrial demand based on $20 silver cannot be sustained when silver reaches $60 or $80 per ounce. But industrial demand cannot be reduced without undermining technological infrastructure that modern economies depend on. The solution requires systemic change that acknowledges silver's true value in technological civilization. This means currency systems that account for industrial metal scarcity. This means monetary policies that recognize the essential nature of certain commodities. This means abandoning the illusion that paper assets are equivalent to physical resources. The transition has already begun. Central banks are accumulating silver. Industrial buyers are securing long-term supply contracts at premium prices. Private wealth is converting paper assets to physical metals. The institutional manipulation apparatus is being dismantled. What remains is the final recognition. When nothing is left to short, price discovery returns to physical reality. In physical reality prices, silver far higher than 4 decades of manipulation suggested. But this recognition requires one final step, a step that acknowledges the true cost of maintaining artificial markets for too long. The last institutional silver short position closed on November 28th at 4:17 in the afternoon Eastern Time. Not gradually, not strategically, a single massive buyback order that represented more silver than total global mine production for 6 months. The trader who executed that order knew something the market didn't. It was the final transaction of a monetary era that had lasted 53 years. Everything after that moment would operate under different rules, different assumptions, different mathematical relationships between paper and physical reality. But the real signal wasn't the size of the buyback. It was the silence that followed. No media coverage, no analyst commentary, no regulatory investigation into market manipulation that had suppressed silver prices for 4 decades. Complete institutional silence around the largest precious metals position reversal in modern financial history. This silence indicates coordination at levels beyond individual banks or trading firms. When multiple sovereign monetary authorities, major financial institutions, and private wealth dynasties simultaneously reposition around the same asset class, they're not responding to market opportunities. They're implementing a predetermined strategy that requires precise timing and absolute discretion. The strategy is simple. Complete the transition before public awareness creates disruption. Allow silver to reach equilibrium pricing gradually enough to avoid monetary system shock, but quickly enough to establish new pricing baselines before industrial shortage becomes a broader economic crisis. The timeline for this transition has already been determined. Industrial silver demand will exceed total global silver supply by 600 million ounces annually within 18 months, based on current consumption trajectories. Physical shortage will become mathematically unavoidable, regardless of price manipulation or paper market intervention. The institutions that previously controlled silver pricing through short positions now control silver allocation through physical accumulation. Same control mechanism, different strategy. Instead of suppressing prices to protect currency systems, they're allowing price discovery to protect industrial systems that currency systems depend on. But this transition reveals something fundamental about monetary authority. When physical reality conflicts with financial manipulation, physical reality always wins. The question is whether the adjustment happens gradually through managed transition or suddenly through system breakdown. The evidence suggests managed transition is underway. Central banks are coordinating precious metals accumulation. Industrial buyers are securing long-term supply contracts. Private wealth is converting paper assets to physical resources. Financial institutions are abandoning manipulation positions and establishing accumulation positions. The reset isn't coming. The reset is completing. And silver prices are the visible indicator of how far the transition has progressed. When silver reaches $70 to $100 per ounce, the mathematical equilibrium with industrial demand and monetary expansion, the reset will be finished. Everything else is just waiting for public recognition of what has already been decided in private. The algorithm that controlled silver for 40 years was never about silver. It was about maintaining the illusion that scarcity is optional when you control the mathematics. But scarcity is physics, not policy. And physics doesn't negotiate. While everyone debates inflation rates and interest policy, the fundamental transition continues in warehouse inventories and vault transfers. Industrial demand that cannot be reduced, mining supply that cannot be increased, physical reality that cannot be manipulated indefinitely. The institutions that understood this first positioned accordingly. The institutions that understood this last are positioning now. Everyone else will understand when positioning becomes impossible. But understanding changes nothing. The silver that exists, exists. The silver that doesn't, doesn't. Industrial civilization requires both currency systems and the physical metals that make technology function. When those two requirements conflict, industrial necessity overrides monetary convenience. The markets that open tomorrow will operate under the same rules that markets have always operated under. Physical reality determines long-term value. Everything else is temporary pricing. The question isn't whether the transition will complete. The question is whether you'll recognize it before recognition becomes relevant.